Steve, October capital markets performance saw the S&P down about 180 basis points and the Barclays Ag down about 75 basis points, which, by the way, is the third consecutive decline in the Barclays Ag and I think the worst month of the year. Did that translate into closed-end fund performance across all asset classes?
It certainly did. When the fixed income market is down, closed-end funds are generally down with it. Muni funds were down about 5%. Taxable bond funds were down about 200 basis points. And equity closed-end funds were down about 4%. That's about 2 times worse than the S&P 500. But keep in mind, the equity closed-end fund market has a lot of bond proxy equities in that of consumer staples and utilities.
Steve, on the discount side, I think we widened from about 4.5 to 6.5 on the all closed-end fund index. I think 4.5 was roughly in the 50th percentile. Does it move to 6.5? Is that meaningful for the market, or to your point in several videos, are there's still attractive discounts that have been there all year at some wider levels?
Sure. I think the names that have been attractive all year have basically had a parallel shift. And so names that were 12% before this month are now 14%. It kind of just moved with that 200 basis point change. But I think what's more interesting is that a lot of popular funds have widened out substantially. I don't know the number off the top of my head, but I've seen plenty of closed-end funds widen out 600, 700, 800 basis points. And so those opportunities, I think those fresher ideas create more short-term mean reversion opportunities. And that's what our portfolio management team is excited about today.
We're shooting this video 2 days post the presidential election. And certainly the outcome of that election was not a high probability for a lot of people out there. Can you talk about what, if any, effect there's been on the closed-end fund market, and any comments you want to make as we look forward now to a Donald Trump presidency?
Sure. I think the story of interest rates is dominating the closed-end fund market. And President-elect Donald Trump's focus on fiscal spending to provide a shot in the arm of the economy, that has basically caused the equity markets to rally. And it's also caused yields to increase on the fixed income side because bond investors are expecting inflation. And so kind of more of the same from October. When interest rates are rising and bond prices are declining, closed-end fund discounts are widening. And so we're seeing a lot of bond funds that the NAVs are down in October, they're down in November, and the market prices are down 2-3x of that amount because investors are, they hear inflation, they get scared. The Fed's still around the corner. The expectations are that they're going to raise in December. And so investors are basically saying, I'm out of the fixed income market, and it's creating a lot of excess supply on the fixed income side. So everything we talked about earlier is basically becoming more acute in the last 2 days, and we're seeing a lot of volatility where 5 to 10 days volume for a lot of closed-end funds, 5 to 10 days daily volume, in the last couple of days, which is really incredible. And it's hitting a market where investors are kind of on the sidelines. And so you're seeing really big price declines, 2 to 5% moves today, which is Wednesday. I think that should continue. And a big part of that is that we're coming into year end, and it's just a kind of quirky reality in the closed-end fund market, but tax loss selling is really powerful and self-fulfilling. And a lot of names, especially on the fixed income side, are kind of circling the drain for performance this year. A lot of names are in the red, and I think that causes more investors to say, look, this is just a different market dynamic, and rates are going up, and they've moved up, the 10-year 60 basis points in just a couple months. Maybe it's time to sell. Let's just lock in that gain or book that loss. I think discounts can continue to widen for the next couple of weeks, but the reality is there's always a buyer of traditional asset classes at a discount. And so looking at munis, we're seeing a lot of 10+% discounts on billion-dollar bond funds.
And sorry to interrupt, but to go backwards, not 60 days, the muni market was trading at an average premium, correct?
At a premium, yeah. And so you've basically seen 15% price declines in a very short period of time. And that certainly excites our team. Everything when we think about allocations is going to be from the top down. But when you think about fixed income, it's a lot more interesting to buy, muni closed-end funds now that the NAVs are down. Looking at rates across the board, a 10-year at 2.1 is more interesting than a 10-year at 1.6. And so it creates the opportunity to diversify portfolios. And so I think there will be buyers of discounted closed-end funds, but maybe not. I don't think you're going to see much discount stability until the end of the year, which is really what creates opportunities. again, there's a big chunk of the market that's already cheap across asset classes, but each day there's new names that maybe are trading a couple hundred basis points narrower than the average closed-end fund. They come to market trying to sell big blocks, and it gaps out to the peer group average. And that volatility, it scares more investors to push prices low. And so, it's going to be dependent on interest rates. If all of a sudden interest rates back down, then closed-end funds will rally. But if we kind of hang around here above 2 on the 10-year, and the expectations, that kind of drumbeat of rising rates from the Fed is around the corner as well, you could probably expect more volatility in the closed-end fund market. That's just to bifurcate, the equity closed-end funds, despite the fact that, a Trump presidency has been good for stocks so far, those discounts have widened out too. And right. So those are always going to be a different part of the story. Those are more driven by, in my view, corporate actions and activism. But those continue to be wide. Equity closed-end funds, opportunities are out there at 16%. But between now and year end, I would say get your wish list together. Stay on top of relative values because they change quite quickly. It's our team's job to have our wish list. But on a day like today, maybe 10 new names popped up that I didn't think would be a trading opportunity, but prices were down 5%. And so I think it's a good time to be watching the market, but certainly one where volatility should remain high.
Steve, very interesting comments. We'll see you next month.
Thank you.